Hey there! Welcome back, traders. Thank you for joining me again on another Survival Guide episode. My name is Chris, your host, and we're going to be covering silver futures during today's episode. But before we get going any further, let's show you how you can apply some silver futures to your own chart. That way you can potentially follow along if you're so interested. The first thing that we're going to do is we're going to go over here to the top left, we're going to click our search bar, and we're just going to type in a /SI. Then you're going to see a COMEX Silver Futures. Give that a click, and we are all set. Now we've got silver futures on our chart. Currently it's showing 15 minutes. We can change it to hourly or whatever it is that we're curious of looking at. But without further ado, let's dive on into it. Here we go. Silver has been in use since prehistoric times. We don't even know who was the first person to discover it or when exactly that was. What we do know is we have silver objects that are dated as far back as 4000 BC. These were found in Greece as well as modern-day Turkey. Silver has a special place in the history of the elements because it is one of the first 5 elements discovered and used by humans. The other elements were gold, copper, lead, and iron in case you need that information for your future trivia session. But today we're going to be focusing on silver futures. It may come as no surprise that silver is the most invested in precious metal commodity after gold. Thanks to its versatility in many industrial uses, many traders consider it a good investment choice in the futures market as well. Silver futures were first traded on July 5th, 1933 on the Chicago Mercantile Exchange, which we all know as the CME. Now, a silver futures contract is a legally binding agreement that covers the delivery of silver at an agreed upon price in the future. This is a contract that is standardized by a futures exchange as to the time, quality, quantity, and the place of delivery, but the price remains variable. In order to help us better understand what futures silver trading is all about, let's just take a moment and use our imagination. We're going to pretend that we manufacture silver medals. We're also going to pretend that we won a contract from the Olympics to produce, say, 1,000 ounces of silver in a 6-month period for all of their silver medals. We're going to say that the current price of silver is going to be $15 per ounce, but there's a stipulation. For some reason, we can't buy it all today. Whether it be we don't have the amount of money that we need to make that purchase at $15 an ounce all today, or maybe we don't even have all the storage space that we need. In order to protect ourselves against any future price increases, we decide to lock in our purchase price at that $15 per ounce price by entering into a 6-month silver futures contract. By buying this futures contract, we then lock in that future price, so by the expiry of the contract, we are guaranteed to buy our 1,000 ounces of silver at only $15 per ounce. Problem solved. Now, if we take a moment and consider the other side of this trade and pretend that we are the silver mine owner. So let's pretend we're the silver mine owner and the manufacturer, which used to be us, approaches us intending to purchase 1,000 ounces of silver in 6 months' time. We might be concerned about the price of silver declining to below its current price of $15 per ounce. We can benefit by selling the silver futures contract available today at $15. This guarantees that we will have the ability to sell our silver at the set price. And at the time that the contract expires 6 months from now, regardless of how price changes, both the manufacturer and the silver mine owner, which is now us, will walk away happy with how the deal ends. Now that we know a little bit about the history that was behind silver itself, as well as how silver futures contracts work, the next important question to answer would be, where in the world can we trade it? I have 3 exchanges here that I've marked off. The first one is the Commodities Exchange, otherwise known as COMEX. This is a division of the Chicago Mercantile Exchange, which we know as the CME Group. On this exchange, silver futures contracts are for 5,000 or for 1,000 troy ounces and have a variety of expiration dates to choose from. At the expiration, the contracts are settled through physical delivery of the silver, however, it is obviously uncommon. Now, COMEX provides its market participants, including producers, end users, hedge funds, banks, proprietary trading firms, and active individual traders, with a central point of price discovery and price transparency, as well as risk mitigation for counterparty credit risks, making COMEX a very appealing exchange indeed for traders. Our second exchange I have marked off is the London Metal Exchange, which we know as the LME. This exchange offers silver forwards curve data to any investor looking to sign up. As an investor, you will be able to see 1 week forward curves as well as up to 36 months forward. Contracts can be traded electronically via the LME Select, as well as through the 24-hour inter-office telephone market of the exchange itself. Our third option is going to be the Multi-Commodity Exchange, otherwise known as the MCX. The MCX is based in India, and as of 2011, it was ranked number 1 for silver trading since it offers just 2 different contracts. The maximum order size is pegged at 600 kilograms with a daily base price limit of 4%. Standard silver futures represent 30 kilograms and are traded in the months of March, May, July, September, and December. You probably are wondering why a buyer and a seller simply cannot just meet and discuss terms and agree on a futures price of silver itself and then just hold their promise and set an expiry date. Well, this kind of thing has been around for quite a while, and it actually does occur. It's called forward trading. But the problem with forward trading is that it's not standard, and therefore it presents counterparty default risk. This means that there is always the likelihood or a potential probability that one party might default on its contractual obligation, especially since there is no governing body regulating the transaction. So, with the exchange that we mentioned, it provides standardization for those products, in this case our silver, and gives us a secure and regulated marketplace where buyers and sellers can transact. This protects us against that counterparty risk. Now here we have an example of a silver COMEX futures contract. We have, just like always, something to give you a way to find it on a chart, which is going to be our product symbol, and that is SI. We did this at the beginning of the video, so hopefully you're following along. Now, the venue where it's traded will be the CME Globex, CME Clearport, or the Open Outcry in New York, which, once again, this is for COMEX itself. Obviously, this will not be the will not be the symbol if you are looking to trade it on, say, the MCX. The contract size will be 5,000 troy ounces, and the price will be quoted in US dollars and cents per troy ounce. Nothing too crazy going on there. As far as trading hours go, once again, Sunday to Friday, 5 p.m. to 4 p.m. Chicago time, with a 60-minute break each day beginning at 4 p.m. Chicago time. And our minimum price fluctuation will be 0.005 per troy ounce, which is equal to $25. The spreads will be 0.001 per troy ounce, equal to $5. As far as the trading, termination, delivery period, as well as the grade and quality, the termination delivery period is important. However, it's not overly exciting, and all of this information is actually available for you on the CME group as always. And if you're interested, I strongly suggest you check over there instead of trying to reserve some mental space to remember all of it. So we're going to skip past that. But as far as the grade and quality, all silver delivery under this contract shall be appraised at a minimum of 999 fineness. That is important because that determines that the quality of the silver has a minimum standard, and that is the 999 fineness. In the world of trading, when there's so many ways to trade something like silver, why silver futures exactly? Well, the first reason is it is a physical asset. So as an investor, ask yourself, how many of your investments can you actually hold in your hand? In today's world of digital trading and paper profits, having an asset that you can carry in your pocket anywhere you go or store in a safe is not just a good way to diversify a portfolio, but it's also a good way to mitigate certain risks. For instance, physical silver is immune to hacking and cybercrime. Also, it can provide a buffer or store of value for our finances during an economic crisis. In most cases as well, central banks react to crises by lowering interest rates so that there is an increase in the money supply. This can weaken currencies and diminish an investor's confidence in the stock and bond market. Since silver is a physically scarce asset with a limited above ground supply, it is far more unlikely to lose its value during periods of turmoil. Our number 2 reason is going to be speculating on the industrial strength of silver in the global economy. From manufacturing and automobile to jewelry and household items, silver is used across many industries today. Its strength in the global economy should translate to higher prices. As these and emerging other markets continue to grow, the demand for silver could experience a rapid increase, which in turn will affect its price. If we were to invest in silver now, we could stand to make significant profits if the demand were to soar. Our third reason is going to be betting on a diminishing supply. This is one of the most attractive reasons to invest in silver today. High mining costs combined with depressed prices for silver have led to lower production numbers in recent years. Unless these factors change, many silver mining projects will remain on hold. Limited supply of silver could obviously be a recipe for prices to rise down the line. And finally, if all of these reasons aren't good enough, we have number 4, and that is silver is relatively cheap at the moment. Silver is cheaper than gold, so an investor can own more silver for less capital. This makes it a potentially popular choice for investors with less capital to work with. Silver is also more volatile than many other assets. This can make it a potentially lucrative investment for active investors looking to capitalize on its price swings, since they can sometimes lead to sharp moves, which can translate to higher profits if you are on the right side of the coin. It's important to understand what makes the silver market move if we want to be successful investors in any type of silver trading. Unlike gold, where the demand comes from predominantly jewelry or investment or just store of value related things, the demand and supply for silver are a little bit different. Silver mines only supply about 85% of the world, where the remainder of the silver supply in the world comes from recycled scrap. So this means on the supply side, silver mines concentrate in certain countries like Mexico, China, Kazakhstan, and Peru. And any disruption from these supplies will impact the price of silver on a global scale. And then on the demand side, silver is used in a wide variety of applications across different industries. So therefore, increased production and new manufacturing facilities will almost always push prices up due to a spurt in demand. So if we pay attention to these type of factors, we can be more informed on where the price of silver might be going. On the subject of what makes the market for silver move and groove, let's keep it going and let's keep the tunes a-flowing. Let's ignore that part. So the strength of the US dollar is something else to pay attention to in regards to the value of silver. The dollar tends to have an inverse relationship with the price of silver. The stronger the dollar, the more pressure it places on silver. We also have a relationship with the increasing oil prices, or as of recently, the decreasing oil prices. So this, among other environmental factors, has led to an increase in demand for alternative energy such as solar. And a lot of solar energy equipment is made with silver. So as the world continues to demand solar energy, that inadvertently increases the demand for silver. We also have a correlation with large and private institutional investors that we should pay attention to. Investors with deep pockets can influence the demand and price of silver. An instance that would make this a little bit more understandable would be when the Hunt brothers almost cornered the global silver market. They leveraged their silver positions and pushed the price through the roof because they had such a large share. Other investors like Warren Buffett, who purchased 130 million troy ounces back in 1997, and iShares, which held roughly 180 million ounces of silver in 2008, also have the power to fluctuate the value of the silver market across the global scale. We also have a correlation with stock market fluctuations. So there is definitely some interplay between how the stock markets fare and the amount of capital that flows into silver. While it is not set in stone, the appeal of silver as an alternative asset tends to increase when traditional investments like stocks and bonds aren't faring so well. And finally, gold prices. Despite all the other fundamental drivers of silver, traders still consider gold to be one of the main drivers for the price of silver. When the commodity market turns bullish, speculators tend to be interested in precious metals, predominantly gold. This increased demand often extends to silver as well, which in turn raises its price. At the same time, when the commodity market is bearish and investors lose confidence in gold, the price of silver also tends to drop as well. Because you've made it this far into the video, I have a present for you. Now we are going to cover just the tips. And in tips, I mean we are going to cover some of the silver futures contract trading tips. The first tip is going to be understand the lingo. Understanding the lingo in regards to futures trading can help us avoid costly mistakes, which no one wants to do. Our second tip is going to be aware of convergence. Convergence refers to the tendency for futures prices to approach the spot price in the market as the delivery date looms closer. And our third tip is always be aware of the maintenance margin. This is the amount of money that we need to hold on to a futures contract. If we fail to maintain this amount, we will get a margin call, and no one wants a margin call. The margin call means we have to add more capital to our account in order to keep the trade open. And if we don't add the capital, the broker has the right to close our position, which means he could lock in our losses instead of us adding capital and locking in our gains. Our fourth tip is going to be to diversify. In recent years, the increased industrial demand for silver has caused increased volatility. Its price has been rising and falling with much greater frequency than gold and other traded precious metals. This level of volatility presents a lot of opportunity for a seasoned and knowledgeable trader, but can also be a double-edged sword and hurt somebody who isn't ready for that type of movement. If we don't have the risk appetite or the trading knowledge that we need to navigate such a volatile market, a smart idea is always to make sure all of our eggs aren't in one basket. And our last tip here will be manage the leverage-related risk. Silver future contracts are leveraged instruments. That means there's always the risk of losing more money than the actual worth of the futures position. To mitigate this risk, we need to watch the volatility of silver prices very carefully. We can also use spreads to offset the losses on one trade with gains in another trade. This involves buying a silver contract at one strike price, but then selling another contract at another strike price. In conclusion, the silver market, the silver futures market more specifically, is one of great potential for those that are willing to take the time to understand what causes the market to rise and what causes the market to fall. It is one that has a very high volatile nature about it. It's even more volatile than gold, as we discussed. If you take the time to put in the work, there's a good chance that you'll receive what you deserve. I look forward to seeing you guys in the next one, and thank you for joining me for another survival guide. But before you go, please click the like and subscribe button below. Cheers, everybody. Happy hunting, happy trading, and I'll see you soon.